I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's creating billions in unallocated bullion contracts. Unbacked. Selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce.
The silver market has been manipulated for years through the disconnect between paper contracts and physical metal. This isn't a theory, it's a matter of legal record. In 2020, JPMorgan agreed to pay $920 million to settle charges of manipulating precious metals markets. The Department of Justice case confirmed what many had suspected all along. Silver's price is not the product of free and fair market activity. AndySchectman of Miles Franklin points to the same repeated pattern. Hammer prices down before options expire, so those contracts become worthless, then let prices bounce afterward. It's become a cycle. But Schectman sees the cracks widening. Physical demand is rising, inventories are dwindling, and the paper games are becoming increasingly challenging to manage. Spoofing, placing large fake buy or sell orders to manipulate price, then canceling them, is still rampant. Outlets like Gold Silver HQ argue that silver's persistently low price isn't natural at all. It's the product of ongoing, coordinated price suppression by big players with deep pockets and regulatory cover. The implications are hard to ignore. If gold keeps rising and the gold-to-silver ratio narrows toward historical norms, silver's upside is massive. A 50 to 1 ratio, conservative by historical standards, would price silver at $80 an ounce. Even a return to 70 to 1 means $60 silver. That's a clear double from where we are now. History gives us the blueprint. The gold-silver ratio blew past 100 in both March 2020 and again in April 2025. Each time, silver followed with a sharp rally. If that cycle plays out again, we could be staring at another breakout, this time not driven by hype, but by a structural breakdown in a system that's been rigged for decades. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I've been thinking a lot about the gold to silver ratio, and you got Goldman Sachs and JPMorgan forecasting $4,000 gold by next year. I think that's pretty reasonable, actually, on many levels. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, where it's averaged about 45 to 1 for the last 150 years. At 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. And so when I think about where silver could ultimately go, there are so many things that are screaming silver and its value right now. UBS just raised its target to $42 an ounce. That's about an 11% increase. But when you look at all of the things that have been happening, to me, whether it be the increase in the lease rate, the lack of shares available to short or to buy to cover shorts on SLV, the massive delay from T+1 settlement in London to T+8 weeks in London, the huge deliveries. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce. That's a solid 50% gain almost. So the way that the market is moving, we're not seeing these massive sell-offs. We're seeing consolidation, choppiness, volatility, but the strength is something that is very different than what we've witnessed before. I'm very, very, very hopeful for what the rest of the year brings for the price of silver. I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's trading billions in unallocated bullion contracts unbacked. Selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. But again, UBS is saying 38 to 42 through September 2025. They're talking just in a month through June 2026. So they're basically saying we're right there. By the way, for the people who we're recording this on Monday, the options expire today. So I expect today to be volatile, just like Friday was and Thursday, but I expect it to shoot right back up tomorrow. We'll see if I'm right when the next contract hits the board. You have to wonder, is it a conspiracy or is it reality when you talk about when Chris Powell says there are no free markets, just manipulations? The traders suck in the speculators, and then right at the end, they smash the price so that the options expire worthless. The big banks get to keep the premium on that, and then it goes right back up. They rinse, wash, and repeat. But this is a game that's much more difficult to do so, and it kind of reeks like we're getting to the end of this game. We've heard that before, but the level of spread in the exchange for physical jumping up 250% last week, the no shares available to borrow of SLV, none when there's usually millions, the 7 or 8% lease rate, highest I've ever seen, the T plus 8 weeks, the deliveries, things are changing, and it's as dumb as a mud wall to continue this game. I think they know that. I also want to talk about perception. You know, I wrote down homes are getting cheaper in gold. Now, homes aren't getting cheaper, but they are in gold. And, you know, people talk about this real estate deal where homes are so unaffordable. They're not unaffordable in gold if you've been holding gold, because measured in dollars, you're getting crushed. Measured in gold, you're winning. Since 2005, it's fallen off a chart. It's gone straight down. The amount of gold that you need to buy a home, it's at almost all-time lows or very darn close to it. So in other words, gold is keeping pace. The dollar is not. This is the point that needs to be understood, is that gold is not here to make you wealthy. It is wealth that keeps pace with inflation. The reason I left my corporate office in Minnesota is because it's the only state in America, and again, they're now re-implementing it, licensing and bonding. And so we're very attuned to anti-money laundering laws and know your client legislation. They said, well, you know, how you know you're not funding terrorism? And he said, well, because we're opening this up to other countries, we are keenly aware of compliance issues in all of these countries. And he said, our software is compliant with AML, anti-money laundering laws, and KYC. Now, you know that, right? You know what KYT is? Neither do I, until I Googled it and figured it out. Well, I listened to what he said. I rewinded it again. He said, our software is compliant with KYC, AML, and KYT. Now, before I tell you what KYT is, I want you all to think about this in terms of stablecoin and this digital surveillance world we've been warning you about. That a lot of people say that these stablecoins are kind of like a CBDC in sheep's clothing, you know, kind of like it still gives the central authorities the ability to monitor, to track the on-ramp and the off-ramp, do all these things. Well, guess what KYT stands for? Know your transactions. So their software is compliant with know your customer, anti-money laundering, and know your transactions. So guess what? What you are buying ultimately is going to be part of this software. You go and buy a couple AR-15s for your home protection, may not be a good idea. You know, you go buy bullets, you go buy alcohol, you go buy cigarette, whatever it is that you're going to buy, guess what?
BRICS nations are steadily reducing their reliance on the dollar in their trade flows. According to OMFIF, an independent think tank focused on central banking, half of all intra-BRICS trade is now being settled in Chinese yuan rather than US dollars. Beyond the yuan, Other national currencies are also being used for cross-border transactions, marking a clear shift away from reliance on the dollar. This is no longer theoretical, it's de-dollarization in practice. AndySchectman sees this as part of a much larger and more calculated move. He believes the dollar will be intentionally weakened to keep the broader financial system alive. That might sound severe, but the evidence is mounting. The US can no longer finance its debt like it used to, and traditional buyers like China and Japan are no longer stepping up. Without them, the Federal Reserve has little choice but to absorb more of the debt itself. China has already dumped over $900 million worth of US Treasuries and has trimmed its central bank's dollar-based holdings for 3 months in a row. Instead of parking its reserves in US financial assets, China is turning to gold. So far, it has added approximately $247.8 billion to its holdings. And it's not just China. Other BRICS nations, including India, Russia, Brazil, South Africa, and Egypt, have also been reducing their exposure to US bonds and shifting into gold. That move is starting to pay off. As gold prices rise, the value of their new reserves increases. This isn't just a political statement or a rejection of Western influence. It's a financially rational hedge against the mounting risks associated with US debt and declining confidence in the dollar. Let's get back to the interview.
Let me expand on that, Dunnigan, and because this is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue, because you are seeing the governments that used to support our debt are no longer doing so, right? You have now the Cayman Islands and the United Kingdom and Ireland. It's a joke. And they understand that the amount of debt, we have to come up with $28 trillion in debt in 3 years when we only take in $15 trillion in tax revenue. We're not there. They understand that. And we're seeing less and less and less buying of our treasuries. So instead, they pass the stablecoin law where all of these stablecoins will be backed by US dollars in order to have demand for a treasury market that is losing demand. So you put that all on the short end of the curve, right? Where I think they're going to do it, and kind of blur the significance of the long end, which I'll get to in a moment. But I think that's first and foremost what they're trying to do. Remember when Janet Yellen did that, that was good for gold, that was good for stocks, it was inflationary. And I think that's what they're going to try to do. At the same time, they reshore all the gold and they're going to let it go higher and higher and higher and higher. Not very easy for the public to discern. There'll be volatility, there'll be consolidation, but it will keep going higher until people feel it's gotten too high. And then they'll probably come in and revalue it to a level much higher. And they're going to peg it to the treasury. Why would they do that? Why would they peg gold to the back end of the treasury market? The short end, the front end, will be backed by these stable coins, which they will pump out by the gazillions, because now they have this synthetic demand, not a organic demand like we used to have when we were revered and we ran a surplus and we didn't instigate wars all over the world and fund wars all over the world, and we're not revered anymore. So the back end of the market, who the hell wants, and especially when Trump talks about creating all of this money to rebuild our infrastructure. So in essence, printing money to build our infrastructure to compete with the rest of the world. They don't want to buy our treasuries. So they will just do the stable coins to get all of this demand for the front end and load the debt there. But the back end, I believe they will peg to gold. As Judy Shelton has said, on July 4th, next year, the 250th anniversary, he has said it repeatedly. Again, she keeps saying it on Twitter. He will peg the 50-year treasury to gold. Why would you do that? And you have to get gold much higher. And I think she keeps talking about gold revaluation. They will revalue gold. And I think Luke Groman, one of the smartest dudes I've ever met, he's talking about revaluing gold. He thinks they'll let it go to $7,000, $8,000, $10,000 and then revalue it to a much higher level to give the Treasury General account $5-6 trillion in free, clear revenue without selling an ounce of gold. And we talked about how that happens. There's miscommunication on that too, because some people think that when the Treasury issues Treasury certificate or gold certificates, gives them to the Fed creates the money, takes the gold, and gives the Treasury money free and clear. Every $4,000 increase is $1 trillion free and clear to the TGA account. The Fed doesn't have control of that gold. They have control of the fiat. They're owed the money value of that gold, not the gold itself. Anyways, if they do that and peg it to the long end of the bond market, she said 50 years first, shorter durations, maybe 30 and 20, later, maybe 10. But why would you do that? Because now you can have zero borrowing costs. You can put a zero coupon on that. The gold redemption at the end is the borrowing, is the interest rate, is the inflation gauge. The more foolish we are in monetary policy, the higher the price of gold goes. To be able to get that at redemption would allow for long end low borrowing costs, almost down to nothing, which would then enable us to slowly reshore our manufacturing at very low borrowing costs, and then to grow our way out of this problem eventually. The only way you get rid of inflation and where we are right now is to produce our way out of it. And we're a long ways away from that, because in order to facilitate the amount of debt that we owe, pay it off, just the $28 trillion in maturing Treasury debt by 2028 with $15 trillion in revenue, we're halfway there. And that doesn't take into account the $3 trillion a year in deficit spending. So you're 25% of the way there. So you have to inflate. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market. And then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs, to reshore manufacturing, to sell treasury debt bonds at a much longer duration at a zero borrowing costs redeemable in gold. I think they're going to do this. I truly do. And I guess we'll see. But I think to save in dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period. So that is my thesis right now. And I'm very, very convinced that this is something that they're, if not implementing right now, it is, by all of the things that we hear and see. It'd be too long for me to go through the whole litany of them, but I think that's where we're going. You know, we had talked before about the Shanghai Gold Exchange and the progress that they've made in both Saudi Arabia and in Hong Kong in this new vaulting structure. So I want to talk a little bit about that, because there has been something in the way of updates. We went back to the beginning of May and we talked about the Saudis had opened up an account at the Shanghai Gold Exchange. And in fact, it had been officially launched. And what it was realizing was a two-way free exchange between renminbi and gold. And at the same time, it's facilitating Middle East investors to directly participate in the Shanghai Gold transactions through the Saudi Treasury. So on June 26th, the Shanghai Gold Exchange opened its international board, a designated warehouse in Hong Kong, and it launched these contracts. We talked about that. What I did just realize is that on the first day, many Chinese and foreign institutions successfully reached transaction. And so this is now in motion. We are seeing countries trading their renminbi, their yuan, directly into the Shanghai Gold Exchange, which is China's official platform for gold trading, by the way. And they're doing it directly without needing, the key to it is that they're doing it directly without needing intermediaries or converting through other currencies like the US dollar. So for investors, this provides opportunities and more efficient access to the gold market. And for Saudi Arabia and China, it puts them closer together. It slices apart, the petrodollar. It gives other options to settle in yuan or renminbi, and then immediately convert it into gold. These are the little pieces, the little by little, the chess pieces that are being put into place that are very, very difficult once fully in place. And there'll be more about this in a moment when I get into the BRICS pay. But suffice it to say, this is a big deal. It is now operational. Gold is being delivered in the warehouse in Hong Kong. And the next one that is being built right now is in Saudi Arabia. Saudi Arabia is already set up in Hong Kong. And through the treasury in Saudi Arabia, other Middle Eastern nations will be able to participate. I was watching Andrew Maguire the other day. I love Andrew Maguire. I don't know if you've had him on your show, but he's one of my favorites. And through his sources, whoever they are,
The price of silver, long restrained by tactics most investors never see, is now running into the limits of its distortion. Meanwhile, the dollar, once the untouchable foundation of global finance, is being sidelined not by political speeches, but by actual trade flows and balance sheet shifts. Countries are hoarding metal instead of bonds, settling in local currencies instead of greenbacks, and challenging a system that assumed it would never be questioned. When the old guard loses control over price signals and currency loyalty simultaneously, what kind of reset comes next, and who gets left holding the bag? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.